40% up. S&P 25.6% up. So monetary metals year to date, May 15th to May 15th, is up a lot more than the stock market. So lately, yeah, the stock market's had this goose. That's fine. We love it because we don't want the market to top with negative news. We want it to be in a happy phase and then top. Your question was again, the CIO of Morgan Stanley several months ago said, no, 60-40 rule out the window. It's 60-20-20, 20% gold now. He knew what was coming. Jamie Dimon knew what was coming. The issue is the timing. And we argued that 2 months ago, the warning signal came up technically that, we're not going to hold. And sure enough, now they're slipping down and we're at the multi-year lows on the bond prices. You go any further and they'll start, what's going on here? And it's not an issue of where's it going. It's just a sense of what's going on. And when the public has that sense, and institutions and foreign governments, then, it's like dump it. Okay, you can't have that. And there's only one alternative. The government can't do anything about it. They, unlike you or me, we can go bankrupt. Do anything about it. They, unlike you or me, we can go bankrupt. They can't go bankrupt. One thing they do is print, like the Japanese are doing, like we'll have to do. And well, there'll be consequences. What will be the consequences? And that's the investment issue right now.
So the latest CPI number we saw for the month of April was 3.8%, up from 3.3 the previous month. A lot of this has to do with the move in oil. And by the way, in the city of Toronto, I'm paying about $5 US per gallon. What are you paying in Denver?
4.5 for the upper grade gasoline. That's not a causal factor. It's a mere wave consequence of the monetary explosion. It's always ongoing. And we could talk about the commodity complex. I think that's a major issue right now.
All right. So why don't we talk about gold? You said so gold is, I guess you could define it as in a period of consolidation right now. It's up around, I think a lot of the underperformance in gold, in my opinion, has to do with the fact that you got these bonds or the yields on the bonds moving up. And at the same time, that's bringing the US dollar higher. What are your thoughts on that analysis?
The dollar relation to the gold is a very pathetic. Dollar index we're talking about now. That's merely the dollar measured versus several other fiat currencies. So it's a competition of which piece of paper is more worthless than the other, and a varying issue, So versus the euro and the yen, which constitutes 70% of the dollar index. The dollar index is very weak. In fact, right now, you're at 98, 99, but you collapsed. We got bearish a year ago in March at 104.50. It dropped down to 97.890. It's been doing this for like 3/4 of a year, mostly below 100, doesn't matter. Momentum, long-term momentum is fully broken with trend structures going back a decade and a half. Stability, uncertainty in that asset category. Which means if you're smart, you don't put your money in there to get the yield. Something's wrong here. You got a borrower that can't pay, so he's going to print it. CPI is merely a reflection of inflation. It is not inflation. It's the increase in the money supply ongoing that's inflation. And it shows itself in stock prices, commodity prices. And when your granddad built a house, it was $4,500. Your father, it was $45,000. If you want a median home today, it's $450,000. That's called inflation. It's reflected in everything, including the stock prices, including gold prices. Some will underperform that. Commodities have vastly underperformed the rate of degradation in the money unit. The S&P has reflected it. If you go back to 2000 to the present and look at M2, how much it's grown percent, S&P reports and are bullish on it. They always, every month or two, they'll up it by 1,000. They're okay. Gold twice in its history since it was legalized in 75 has had 2 bull markets. Each of them was 8-fold move from bear low to bull high. Our bear low was 1,050. You do the math. So something like 8,500 would merely match the dimension of the bull market that peaked in 2011 or the one that peaked in 1980. In terms of multiple gain from bear low to bull high. So that would merely be, ho hum, I did it a third time. Well, so JP Morgan's assessment, I didn't even read it, but I saw the conclusive number. It was probably fundamentally based. It was 9,200, which happens to be in that ballpark. I don't think gold will stop there. I think the crisis we're facing will take gold to some level that I can't predict. I don't have a target, except to say a lot higher. The one I'm most focused on is silver, because I think silver could go absolutely parabolic.
And the crisis you're talking about is you're talking about the
Copper was stuck in a price range for multiple decades, between 50 cents and a buck 50. 1970s, 1980s, 2000, 2005. In late 2005, copper decided to move up out of this old reality, 50 cents to a buck 50. And when it crossed to a buck 50 in late 2005, within several quarters, it was $4.10. Wow. No headlines. It was peculiar to copper. It didn't happen in all the other base metals. It wasn't because gold was exploding at that same time. It was copper went berserk. And then, yeah, it had sharp sell-off after that peak, but it lived in a new range around 350 for decades, a couple decades since 2005 to 2020 something. And 3 to 4 times the price of its prior average multi-decade price. But when it did it, the point is it did it in an emotional burst. Lead did the same thing in 2007. It had a similar chart type situation. Exciting metal, lead, okay? Silver had the same. We know there's been a lot of that, institutional manipulation. But the market said, no more. I'm out of here. And usually when markets get overpriced at a high, they go down more than they should to correct. And when they're underpriced at a low for too long, when they correct to the upside, they quite often will go maybe twice as far as they reasonably should in an emotional burst, like copper did. We measure silver on a logarithmic scale instead of an arithmetic normal dollar price chart, where already it's more than doubled. From $4 to 50, you add $45 on top of 50 and end up with 95. So when it got to 95 late last year, that doubled the dimension of that range. But when you go to a logarithmic scale, which is the best way to do it, copper, for example, back then, when it went from $1.50 to 410, went up to a ratio scale dimension beyond the prior reality. Silver, if you do the same thing, you had a range from $4 to 50, repeated to everything. It'd almost be like Bitcoin being 30,000 right now. That's what Ethereum's done. So crypto does not look good. And the issue then becomes, if we have another leg down, is not where you're going, what's it going to do after that? This is a new beast. It started futures trading in 2017. So it's not even 10 years in the futures market, which is where really the activity began in terms of public awareness. If you wipe these guys out, and already you've done a good job on Ethereum and a pretty good job on Bitcoin in terms of how many years of longs have you wiped out. If you take them down another step, it's not an issue of the technicals then. Then it's an issue of, hey, this isn't a correction. This isn't even a 50% bear market, which we've already had. This is saying this whole game was wrong. It fundamentally isn't a new reality currency. It was, it's a tulip bulb mania. It's our version of it. Now, I'm not going to predict.
copper. It's going higher. You didn't throw out a target number, but you said $78 is quite easily attainable. With regard to oil, it's currently at $100. You think it's very cheap here, but you would not be surprised if we saw a pullback down to $80. And you must buy it at $80 because it's going significantly higher. And Bitcoin, you're still very bearish on Bitcoin. Did I miss anything?
Yeah.
And I guess your big concern about everything has to do with the debt levels and what's happening within the bond market. Bonds going lower, yields going significantly higher.
It's causing a wave effect in so many areas, financial community particularly, though nobody's paying attention to it for some reason. In fact, the spread between XLF and the S&P, where you divide the price of the financial sector ETF into S&P, go back 20 years or so, it's making new multi-decade historic lows. XLF is melting in value relative to the S&P. What's going on there?
The S&P 500 flashing topping signals combined with the vertical blow-off top in semiconductors indicates that the AI rally has reached the final stages of euphoria. Retail investors have jumped on the last train while institutions are waiting for the signal to exit. We saw this exact same movie during the dot-com crash of 2000. In my 30 years, this pattern has never changed. When the leading secular runners put in a vertical exhaustion top, winter is just around the corner for the broader index. So, where will the smart money fleeing equities go? To the ancient safe havens, of course. Gold and silver are coiled springs poised for massive gains. A parabolic breakout for silver is highly rational. It offers a hedge against inflation, and its price is tightly compressed due to industrial supply deficits in both the green energy and semiconductor sectors. Gold opens the door, but silver breaks it down. If global inflation and money printing continue at this pace, then yes, $100 oil becomes the new normal and is actually cheap. However, waiting for an oil pullback before buying is a classic veteran trader tactic. You never buy an asset moving vertically. A 5 to 10% correction triggered by a temporary easing of geopolitical risks will be the final boarding ticket for energy commodities. Why do cryptocurrencies look so weak in this environment? Because crypto thrives on excess system liquidity and pure risk appetite. As the S&P 500 tops out and the bond market fractures, institutional capital is the first to de-risk away from highly volatile assets like Bitcoin. This current weakness in crypto is an early warning siren of a looming global liquidity crunch. Finally, we hit the critical warning. The window is closing. This is the final wake-up call for investors. The time to rebalance portfolios, exit overextended tech stocks, and rotate into cash, gold, commodities, and defensive assets is rapidly running out. When the liquidity door slams shut, those left inside will get burned. What we are looking at is a clear stagflationary environment and a financial reset. We are on the eve of a massive global capital migration out of paper assets like equities and bonds and into hard assets like gold, silver, and energy. Buckle up, the markets are about to get rough.